Every day, more than 60,000 cargo ships cross the world's oceans, carrying over 90% of global trade. Most journeys are uneventful. Goods leave port, travel thousands of miles, and arrive safely at their destination. But sometimes things go very wrong. Containers tumble into the sea, ships catch fire, storms tear cargo apart, and billions of dollars in goods are lost in an instant. This video explores what really happens when cargo is lost or damaged at sea. Who's responsible? How do companies recover? And why are some still shipping goods without proper insurance? First, let's see what actually happens when cargo disappears into the ocean. The ocean is an unpredictable workplace. Even with modern weather routing and navigation systems, ships face constant threats. Among the most common causes of cargo loss are severe weather events. Rogue waves, gale force winds, and unpredictable swell patterns can shift a ship's balance, toppling container stacks and throwing hundreds overboard. Improper loading is another major risk. If containers aren't stacked evenly, or if the ship's listed weight doesn't match the real weight, the vessel can become unstable. In 2020, the 1A Puce lost over 1,800 containers in the Pacific during a storm, one of the worst losses ever recorded. Investigators linked it to high container stacks and rough seas. Stack collapses also happen when lashings fail or cargo isn't properly secured. Fires, while less common, can be devastating. The Maersk Honum fire in 2018 killed crew members and destroyed hundreds of containers, raising serious concerns about shipping hazardous materials. And then there's piracy. It's less common than before, but still a threat in areas like the Gulf of Guinea and the Strait of Malacca, where ships can be hijacked and cargo stolen. Now I bet you're wondering, when losses happen, who pays the price? When cargo is lost at sea, or even intentionally thrown overboard to save the ship, someone has to cover the cost, but it's not always clear who that is. That's where an old but still used maritime rule comes in, something called general average. General average is a legal concept that goes all the way back to ancient Rome. It's still used today in international shipping. Here's how it works. If the crew takes action to protect the ship and the rest of the cargo, like throwing some containers overboard to keep the ship from tipping, then everyone who had cargo on that ship has to help cover the financial loss. In other words, it's a shared responsibility. It might sound a little strange, but it's actually a way to make sure that no single business takes on the entire hit if their goods were sacrificed to save others. It's like splitting the bill for damage that saved the entire shipment. One well-known example was the Ever Given, the giant ship that blocked the Suez Canal in 2021. After it was freed, the company declared general average, meaning every cargo owner on board had to help cover the cost. But here's the catch. Shippers couldn't get their goods unless they paid their share or showed insurance coverage. If not, their cargo stayed stuck, even if it wasn't damaged. It may sound old school, but general average still plays a big role in shipping today. It spreads the cost when disaster strikes, instead of leaving one business to foot the bill alone. Let me take you behind the scenes of how liability works in maritime trade. So when a container is lost or damaged, who shoulders the financial burden? In most cases, responsibility depends on the Incoterms, the international commercial terms agreed upon in the sales contract. These rules define when risk transfers from the seller to the buyer. For example, under FOB, or free on board, the buyer assumes risk once the cargo is loaded onto the vessel. But under CIF, cost, insurance, and freight, the seller pays for insurance and assumes risk until the cargo reaches its destination. Regardless of the Incoterm used, shippers often rely on marine cargo insurance to recover losses. But not all insurance policies are created equal. Up next, let me walk you through the insurance puzzle most shippers don't fully understand. There are two main types of freight insurance: all risk and named peril. All risk insurance offers the broadest protection and typically covers any damage or loss unless specifically excluded. Named peril insurance, on the other hand, only covers risks that are explicitly listed, such as fire, theft, or collision. But here's the catch. Some businesses choose to ship goods without full insurance coverage. In fact, many small and medium enterprises underinsured their shipments or skipped insurance entirely to save on costs. This decision can prove disastrous. A single container of electronics or pharmaceuticals may be worth hundreds of thousands of dollars. If lost at sea, that value is unrecoverable without insurance. The claims process, even with insurance, can be lengthy. Shippers must prove the extent of loss, demonstrate proper packing and documentation, and often engage in negotiations with both carriers and insurers. It's not always straightforward, and many claims are denied due to vague policy wording or exclusions. Now I know you're curious. Just how much cargo gets lost every year? According to the World Shipping Council, an average of 1,500 containers are lost at sea every year. In extreme cases, that number spikes. In 2020 and 2021 alone, over 3,000 containers were lost annually, driven by increased volumes, higher stacks, and worsening weather conditions. The economic impact is enormous. For shippers, the loss of inventory disrupts operations and damages customer relationships. For insurers, each incident represents a payout and a reassessment of risk models. For supply chains, the ripple effects include shortages, delays, and increased costs. Let's end with a look at how smart companies protect themselves before disaster strikes. So what can be done? First, accurate weight declarations are essential. The Verified Gross Mass (VGM) regulation requires shippers to declare the total weight of each container before loading. This helps prevent stack collapses and vessel instability. Second, proper packing and securing of cargo can minimize damage. Many losses occur not because of external events, but due to poor preparation inside the container. Third, companies should seriously evaluate their insurance policies. It may be tempting to cut costs, but skipping insurance can expose a business to catastrophic loss. All risk coverage may cost more upfront, but provides critical protection when things go wrong. Finally, staying informed about vessel routes, weather patterns, and carrier reliability can help businesses plan smarter and avoid high-risk voyages. Before we wrap up, here's what this all means for the future of global shipping. Global shipping is a marvel of modern logistics, but it's far from bulletproof. When goods are lost or damaged at sea, the consequences ripple through legal systems, insurance firms, supply chains, and the bottom lines of businesses around the world. By understanding the risks, the legal structures like general average, and the importance of proper insurance, shippers and logistics professionals can make better decisions to protect their cargo. If you found this video helpful, consider subscribing for more deep dives into the hidden systems behind global trade. And if you work in logistics or supply chain management, drop a comment. Have you ever dealt with lost cargo? Thanks for watching.